Hey everybody, welcome to the 2025 year in review for the Lund Loop. For those of you that don't know me, I am Brian Lund. I'm the publisher of the Lund Loop. What is the Lund Loop? It is the first and longest running stock market focus Substack. It's an outgrowth of a WordPress blog I started in 2007. I myself have been trading since 1985, for a lot of that time really badly. But at some point, I learned technical analysis, and my goal every day now is to get better, is to refine my process, and to find that work-life balance. Right, the work being the stock market, trying to make money in the market, the balance being the rest of your life. So, the Lund Loop is a fantastic community. There are over 10,000 free Lund Loop subscribers, but you really get into the community aspect when you become a paid Lund Loop subscriber, because you get access to our trading room, which is really more than a trading room. It's really a community room. It's where we share ideas and we give each other a hard time. And it's really a great place to be. So if you like what you see here today, consider becoming a paid Lund Loop subscriber. Okay, as with everything in the Lund Loop, this is going to be real and raw, which means I'm recording this live. There's no retakes, there's no overdubs, there's no cool, like nothing's going to come in from the side. There's no graphics, no production, because we just want to keep this as real as we keep our trading and our investing. I want to give you a little bit of level setting before we go into the review. First of all, I'm couching this as what I did right and what I did wrong, just because that's the easiest way to divide things up. Those are terminologies that everybody understands. But when I'm talking about things I did right, there's no ego, there's no hubris behind it. There's no like, hey, look how great I am. And when I'm talking about things I did wrong, there's no beating up myself. I'm at a spot in my life right now where, ethics and morals aside, when it comes to process, I don't really care about what is right and what is wrong. I just care about what works, what is furthering you to get to your goal. So we're going to say, I did this right, I did this wrong. But what I'm really doing is throwing these things out there as objectively as I can so that I can look at them. And I want to say, hey, these are the things that you did right. Don't forget to do them, because sometimes you forget to do them. So remember to do them in 2026. Here's the things you did wrong. Sometimes you fall into these patterns. Try to avoid doing those things, but it is a very non-judgmental process. One other thing I'd like to mention, because of the format here, because it's unidirectional, because I'm on a screen talking out like this, at some point it's going to seem like I'm talking to you. But I'm not talking to you. I'm really not. Whenever I do a video like this, whenever I do analysis of a chart, whenever I talk about risk reward, whenever I say, here's my opinion on what the market is doing right now, the first person I am always talking to is me, because this process is a reinforcing process for me, for my best practices, for what works to get me to my goal. It's just like you can't go to the gym once and work out and be in shape the rest of your life. I need to keep doing this over and over. So it may seem like I'm talking to you and you may think, who's this guy that thinks he's an expert to tell me this? I'm really talking to myself. And if this helps you, that's great. But I'm the first subject for these conversations. So, okay. So let's jump into it. Normally what I would do is I would do what I did wrong first, because I like to hear bad news first and then hear the good news. But I'm going to flip it up this year. I'm going to go through what I did right first. And I've got notes on the screen here, so I'm going to refer to them. Again, this is live, so you got to just take it for what it is. All right, so the first thing on what I did right, it's kind of a cheat. It's a half right. I didn't do it fully right. Coming out of 2024, one of my review things was I needed to get bigger in size, especially when we were in a risk on market. One of the first things I do in every daily update is try to determine where we are risk on, risk off. And we had a lot of risk on moments this year. Now, I did increase my size substantially from 2024, but I did not increase it as much as I probably should have. I think I could have made more money if I had pushed my position size more. One of the reasons I didn't do it, same reason I didn't do it in 2024, is because, like a lot of us, I am anchored to a position size from my formative years of trading, right? And so if your big position is, 1,000 shares when you are starting to get your feet wet, or let's say it's $25,000, you're always going to kind of have that in the back of your mind. And it's important that you're actively revising those sizes so that they are in line with your portfolio, because you need to have sizes that when they move in your direction actually move your portfolio. So I was able to do that more in 2025 than I did in 2024, although I don't feel like I did it quite as much as I could have. So that's one thing I did wrong. That's one thing I did right. Half of it wrong, half of it right. Second thing that I think I did right, I noticed a long time ago, due to the fact that I'm a stay-at-home dad, and I usually take my kids to school right around 8 o'clock in the morning, and I'm usually back by 8:30. And I noticed many years ago that that was often the time when, if the market was going to reverse from either, let's say a gap up and then fail, or a sell-off and then a stabilization, that was the time frame. However, this year that was a particularly repeatable pattern where we would see aggressive sell-offs in the morning, and people would be running for the hills and freaking out. But by 8:30, maybe 9, we'd stabilize. And a lot of those days would turn around and end up ramping, sometimes getting back everything that was sold off, sometimes following through the next day. So this year I particularly keyed off of that time frame, used it as a spot to either add or start positions, and also, if I wasn't yet at a stop in positions, not pulling, the trigger, not jumping the gun and saying, "Oh my gosh, the market is tanking. I'm going to sell," and then finding out that it stabilizes later and then retraces everything that sold off. So identifying that pattern and really honing in on it, that was something I did right. What else did I do right? I use options strategically this year better than I have any other year. I'll admit it, I'm not very good at options. I usually use options just as pure leverage. I don't have a lot of complex strategies, but I made a decision this year that I was going to use them in a more thoughtful way. When it comes to trading, there's basically 5 different types of trades. There's a scalp, there's a day trade, there's a swing trade, there's active investing. That's where you want to acquire a position over a long period of time, but you want to be a little bit more strategic in when you get in and when you get out. And then there's long-term investing, which is kind of set it, forget it. When it came to active investing this year, I did a lot of things with options that made it a lot easier for me. Now, I said in the promo to this that I wasn't going to do any charts, but I think I just have to go to some charts here. Let's see. I go over to, for example, Tesla. So here's another thing I did right this year. I identified the Tim Waltz bottom, right? That dipshit Tim Waltz, right? And this is not a political statement. This is just a contrarian statement of an idiotic politician who is rooting against an American company. So that was the Tim Waltz bottom. That's when I started to get a position and build a position in Tesla, built it through this area here, here, here. Then when we broke out and ramped up to here, I started writing calls, laddered calls out against the position that were expiring in December. There was a fat premium on them. And what it allowed me to do is not really sweat this up and down action here. It allowed me to lower my cost basis quite a bit. Another name that I used options on very strategically this year was ASTS. So we were big in ASTS in this area here into this breakout. When we got up into this area, what I did was I sold my commons and I took some of the profit and I rolled it into longer term options. Well, that didn't look so great here, but it's ended up looking very good here. So I locked in the majority of my profit, but still gave myself some upside. Another thing that I've been doing a lot with options lately is when I'm trying to get into a position that I want to build over time, that I want to hold over time, I'm selling puts at lower prices, so that if price gets down there, I've got a lower cost base. If price doesn't get down there, I've got some premium that I collect. I've also been doing the opposite, selling calls against sometimes partial positions and sometimes full positions that I don't think are going to get hit. The whole purpose of this is to, you know, over time take down the cost basis of a position that you want to hold and that you can't really hold based upon daily technicals because you want to hold it for like weeks and months. So I was happy that I used options a lot more strategic this year. Let's see what else. I stayed with the technicals and the trends. Actually, I guess I should flip this. I guess one of the best things I did this year was I identified the April tariff tantrum as an overreaction. Um, so let's go over here. Let's hang on. So the first thing I did was I realized early on that it was time to put the brakes on trading. But when we really started to go crazy into this area here, I saw or I heard a familiar narrative that I've heard many times before. One of the advantages of being around so long, starting in 1985, is I saw the 1987 crash when we dropped 23% one day. I saw the dot-com implosion. I saw the flash crash. I saw the financial crisis. I saw the COVID crisis. And it took me all those crises, because in every one of those, there was a part of me that said, okay, this time it's different. But it took all those crises for me to say, you know what? It's not different this time. The reasons we're selling off, the existential reasons, are different, but the outcome will not be different. In fact, people were talking at that point about the American century being over. And, you know, in addition to understanding the market mechanics, I also looked at the numbers and, you know, was very verbal about the fact that the United States is an 800-pound gorilla. These other countries can't just take their balls and go home, even if they all got together. They had to come to the table at some point and work with us. And I was very vocal about this. This is a post I put out. When did I put that out? Put that out in March. Yeah. Let's go over there. And I said, there's always a reason to sell. And I gave this long-term chart talking about all the reasons to sell. And I said, this is not the time to sell. And so what I did during this period was I very strategically, slowly acquired positions in names that I thought would ultimately, you know, win the day. You know, all the names, the big cap tech names, the names that were overly beaten down. And I just slowly, methodically acquired them, did not pay attention to technical analysis on these things. This was a macro theme. And sure enough, you know, we did find a bottom. We started to ramp. And then after that, the thing that I did best was I stayed with the trend, because as we got up into this area, people were talking about, hey, we're going to roll over. Hey, there's going to be a second dip. There's going to be another shoot. And the technicals did just not support that. They did not support that. And so I stuck with all these names that I picked up into this area up here. So that's the thing that I did right. Let's see what else. And the last thing that I did right was, and this is the biggest one, I think this is the biggest one, and it's not even really that much focused on making money. Everybody's got to choose how they interact with the market. And I think a lot of that has to do with your age, what other commitments you have in your life. And so I'm at an age where I'm trying to be as efficient with my interaction in the market as possible, because I also want to have that life balance, right? And so if you look at it like this, like you need 100% focus and participation in the market to do well, and it takes up 100% time, right? What I was trying to do is figure out what could I change in my approach to the market that could get me 95 or maybe 90% of that engagement of the market, but drop my time to like 50% or maybe even less, right? So, and did I really need that extra 10% of engagement in the market to stay profitable? So I was trying to figure out how to get those levels readjusted. And so there's 4 things I did this year that really helped my my trade life balance. First of all, I stopped scalping futures. Anyone that's been in the Lund Loop for a long time knows that I was a big scalper. I think, if I'm being honest, I think this was an ego driven thing. I think scalping is very hard and I'm pretty good at it. And I think I like the fact that I got money from doing something that was hard, even though I tell people all the time, you don't make any extra money. You don't get any extra points from finding that obscure stock or getting in that weird trade. Why not make it easy on yourself? I was making it hard on myself because I think that kind of stoked my ego. Yes, trading or scalping futures was a good way to get cash flow in choppy markets, but there was just so much downside. First of all, I had to watch every tick like a hawk. It was super stressful. There were days where when the market was closed, I felt an adrenaline dump because I had been so focused on the market. That's not good when you're 58 years old. And finally, I realized that sometimes I was watching the future so intently, watching my positions, getting in and out, paying so much attention to it that I didn't pay attention to regular stock names that just trended higher all day long. I could have made more money with them with much less stress. Also, I wasn't watching what was happening in the overall market. So I quit doing futures scalping. I'm going to say maybe 6 months, maybe it's 4 months before the end of the year. That was a big, big thing. Next thing was I stepped away from the screens more this year. There's this period, that 8:30 to 9 period I talked about. There's usually about an hour and a half to 2 hours after that where the market really doesn't have anything important going on. It's either there's this intraday lull, or if it's in a trend update, it just keeps going up, or if it's a trend down day, it keeps going down. So a lot of days during that period, I actually stepped away, went outside, I hiked, I did something healthy. In correlation with that, I really leaned into alerts. So I didn't just walk away and say, I'm not watching the positions or I'm not watching the market. I set up strategic alerts in TradingView uh, that if they would go off, I would be like, okay, I need to pay attention to something. I would just do it on my phone. I also made sure all my stops were in and I knew, where I was going to be out on things. So it's like I wasn't just walking away and saying screw it to the market. I had fail safes in place. I had things that would alert me. But if there was nothing significant going on, I could get away from the screens and have a little bit more balance. So that's another thing. And then I think the final thing was, and this is for sure the most important thing, is in October, I started raising cash, selling positions, and then I actually paid myself. I gave myself a nice payment that I pulled out of the market. I don't think I can remember the last time I did that. I always think like I need more money in the market. I got to keep all my money in the market. I did that very deliberately because, again, that work-life balance thing, I wanted to enjoy the fall. I wanted to enjoy the holiday season. It had been a fantastic year up to that point. Um, I wanted to take money out of the market to give myself a cushion and to reward myself. If you're the big boss and you're killing it, you got to pay yourself. And that really helped during November when the market was kind of choppy. I didn't have to worry about being in there and fighting for every dollar. So I think that work-life thing was the most important because ironically, when you're in a better spot mentally, when you feel more calm, less stressed, you're going to do better in the market anyway. So it helps you in your market analysis and your market performance. So, all right, so that's what I did right. Let's go to what I did wrong. Okay. All right, here's what I did wrong. And let's go back to the screen here. So before the temper tantrum, when we were in this period, the end of last year and the beginning of this year, what I didn't do is I didn't switch to weekly candles for positions that I was trying to build long term. So this is before, if you look back at the charts here, so I stuck with the technicals really well here. Okay. I took my time and acquired positions with the idea that there was no existential threat to the market here. I used options to bring down the cost basis of positions I wanted to actively invest in here. But on the front half of the year, I wasn't really doing any of that. And one of the things I should have done is I should have gone to a longer time frame, because what I watched again and again was names that I was really willing to trade around to build over time, and they would be going fine. Then one day, maybe 2 days, would just knock them out of the box for me. And then I would go, oh, and I'd sell. And the next day or the next 2 days, they'd go right back to where they were. So I should have broadened my time frame out on some of those names that I wanted to acquire. I wasn't quick enough on understanding to back away a little bit. We already talked about position size. I didn't scale it up enough. That was a half and half, right? I did better than 24, but probably not as good as I should have. Something for sure that I did wrong this year was I let narrative creep in. I'll give you an example. Oklo was a stock that we traded, did very well in. I didn't know what Oklo did. I didn't care what it did. When I found out that they had no product and no revenue and no potential product or revenue for like 3 or 4 years, it changed how I felt about that stock, even though the technicals didn't change. So there were too many times, again, where I listened to the narratives instead of paying strict attention to the technicals. I think another thing I listened to too much was macro news. Sometimes I would get up and I would just open my phone and start scrolling and seeing all the doom and gloom, and that, you just never know how that sets you up for the day. You never know if that makes you more likely to ignore the technicals. So that was not great. Let's see what else. Yeah, so here's the last thing that I did wrong. And this is by far the most important thing that I did wrong. And I'm going to try really to articulate this clearly because it's a super important point. Almost every time I've done a post-mortem at the end of the year, I have way more things that I did wrong than things that I did right. I mean, that's pretty much any period of time, because by nature, you're just going to make more mistakes in the market. That's just the way it works. So I always look at my list and I go, okay, I've got 7 things I did wrong, 3 things I did right, 10 things I did wrong, 5 things I did right. This year, as I was putting the list together, I couldn't find that many things that I did wrong. And I really tried to be objective. And I tried to dig and I tried to say to myself, come on, are you missing stuff? But I couldn't come up with it. I had more things that I did right than I did wrong. And when I realized that, there was a part of my brain right back here that started to get this idea that was coming up into my forefront. And the idea was, you've been doing this a long time. You spent 20 years slapping around and not doing well. Then you spent the next 10 progressively getting better. And then you spent the last 10 being consistently profitable and honing your game. I think you've gotten to the point where you've mastered the market. I actually had that thought coming up. Hey, more things right than wrong. You've mastered the market. And that's when I said, oh no, don't ever think that. That is hot death to think that. So I didn't actually fully do it wrong, because I didn't complete that thought, and I caught myself, and I am self-aware of it. But there was a temptation for me to go, I got it. I did it. I'm a master of the market. Instead, what I'm remembering is how forgiving this market was, how much grace this market gave us outside of the tariff tantrum, how much the market didn't care if your entries were a little sloppy, how much the market didn't care if you pulled your stops and didn't pay attention to your risk management, how much the market didn't care how high a stock went. I mean, this was a market where you could see a stock go up 5% one day, 9% the next day, 11% the next day, and still catch a 15% move on the 4th day. That is not a normal market. We are not in a normal market right now. How long will this market continue to be like this? I don't know. But what I do know is I haven't mastered anything, okay? I still need to follow process. I still need to do reviews like this, not just yearly, but daily, right? I still need to throw ideas off the community. I still need to listen to people that are smarter than me. I still need to focus on risk first before how much I'm going to make. And I can never let myself get into a spot where I think, oh, I got it. Because as any trader knows, those days when you think, those days when you are doing your best and you're just killing it and you're on a run, that's almost always when you have a just gut wrenching loss that, brings you back to earth. So, anyway, I hope this was helpful to you. I hope you identified some things maybe through me talking about what I did right, what I did wrong. Maybe it rang some bells for you. I I strongly suggest whether you are a beginner or a professional, uh, I can guarantee you will do better in 2026 than you did in 2025 as a member of the Lund Loop. We are all about cutting through the bullshit. There's no guru stuff in here. This isn't a picks service. This is harnessing the power of a community to figure out what names have the best chance to move the most in the next 1 to 3 days and then 1 to 3 weeks. And that's it. Lather, rinse, repeat. We don't talk about politics. We try not to talk about macro stuff. We talk about the names that are going to make us money. And this will be my last thing I'll say here. And we make money for a purpose, not to get a Lambo, not to show how cool we are, not to lord over other people. We make money for a couple of reasons. One is to have freedom. If you make money, enough money, you can live where you want, you can do what you want, you can work when you want, you can work with who you want. We make money for financial stability for our family, right? And we make money to support the people and the communities and the causes that we care about. So there is a real reason for what we do, and that's why we do not fuck around here. Okay, we're serious about making money. We have fun. It's a great group, but this is not some get rich quick BS newsletter service going to charge you $3,000 a year. This is a real set of traders and investors who are here to help everybody get better at what they do. So hope you become a subscriber. If you do, I will see you in the trading room. And until then, see ya.